All right, good morning, everyone, and welcome. Thank you for joining us today as we take a closer look at the One Big Beautiful Bill Act, tailored specifically for nonprofit leaders, finance teams, and advisors. This session will provide a clear breakdown of the recently signed act and offer a practical refresher on key FASB standards impacting nonprofit organizations. We've got a great lineup of speakers with us today. We have Diana Mill, audit partner at ML&R. Diana focuses on serving nonprofit organizations and employee benefit plan audits. She has over 23 years of experience providing audit and consulting services to small and mid-sized businesses in various industries. She also manages federal single audits in compliance with government auditing standards, subject to uniform guidance. We also have Poonja Patel, audit partner at ML&R. Poonja brings over 19 years of experience working with privately held companies in a variety of industries. She has worked in industry finance, which allowed her to manage budgets and forecasts for worldwide operations, as well as preparing public filings submitted to the Securities and Exchange Commission. And I'm Shannon Peterson, a tax partner with over 19 years of experience providing tax compliance and consulting services for clients. Since joining Maxwell & Ritter, I have worked with a variety of clients, but have found my niche and my passion working with nonprofit organizations and also large family groups. Before we get started, just a couple of quick housekeeping notes. This session qualifies for 1 hour of CPE credit. To receive credit, you'll need to stay for the entire webinar and respond to the polling questions that will appear throughout the presentation. We'll wrap up with a Q&A at the end, so if you have any questions along the way, please use the chat function. One of our team members will be monitoring the chat and making sure your questions get to us. We'll try to address as many questions as possible, but we have a lot of material to cover, so if we don't get to your question, we'll follow up with you via email after the webinar. If possible, please join from a desktop or laptop computer, and please turn off any AI note takers. With that out of the way, let's go ahead and jump into our presentation materials. Like I mentioned, our agenda today is small but mighty. I'll spend the first half of our presentation walking through the tax changes under the One Big Beautiful Bill Act and how those impact nonprofits. Then Diana and Poonja will lead us through our FASB standards refresher, and hopefully we'll have some time for Q&A at the end. Now, I've already said One Big Beautiful Bill Act too many times for one day. So for the rest of the presentation, I'll be referring to it as the OB3, the new tax law, or the 2025 Tax Act. So how does the OB3 impact exempt organizations? Well, in a lot of different ways and ways you actually might not expect. There are obviously the provisions that impact exempt organizations directly, but there are also provisions impacting exempt organizations as employers, and provisions impacting other types of taxpayers that will indirectly impact exempt organizations. So we'll go through all of those today, but first, let's take a step back and look at the bill as a whole. So it became pretty clear after the election last November, and as Republicans really started to gear up to extend the many tax cuts from the Tax Cuts and Jobs Act that were set to expire at the end of this year, that nonprofits were likely going to find themselves in the crosshairs of helping to pay for those tax cuts. The Joint Committee on Taxation estimates that the charitable related provisions in this bill will raise an estimated $84 billion in tax revenue over the next 10 years. Some of that $84 billion will come from provisions directly impacting exempt organizations, but the largest chunk of that $84 billion, about $63 billion, is from the new 0.5% floor on contributions of individual taxpayers who itemize, which we'll discuss more later in the presentation, but just keep that number in the back of your head. There were actually even more revenue raiser proposals that were initially included in the House bill that ultimately didn't make it into the final bill. One of which was the increase in unrelated business taxable income by the amount of certain fringe benefits. Those of you that were around in 2018 probably remember this as the parking tax. You probably remember filing a lot of Form 990Ts that you never had to file before to report these fringe benefit expenses as taxable income and pay tax on those amounts. Luckily, that was repealed a couple of years after the Tax Cuts and Jobs Act, but was resuscitated in this bill, in the House version of the bill. And it would have been effective for tax years beginning after December 31st, 2025. I think we all sighed a collective sigh of relief whenever this was removed in the Senate version, but I think it's important to note because it seems like maybe Congress sees this as easy money or low-hanging fruit or something that they can easily add into any future legislation if they're looking for revenue offsets. The next couple provisions impact private foundations. So in the interest of time, I won't go through those, but they're included in the materials if those are of interest to you. But I do want to talk about the proposal for the change in research income. In the House version of the bill, there was a proposal where only income from fundamental research that is made publicly available would have qualified for the exclusion from unrelated business income. So meaning industry-sponsored or proprietary research income would have been treated as unrelated business taxable income. This would have been effective for amounts received or accrued after December 31st, 2025. Again, this was removed in the Senate version, but I think gives us a little bit of insight into what Congress is thinking and things that we might see pop up in future legislation. All right, now let's talk about the things that actually did make it into the bill. So the first was a change related to the excess compensation for tax-exempt organizations. Under the Tax Cuts and Jobs Act, there was a new 21% excise tax imposed on covered employees with compensation in excess of $1 million. Under the OB3, that 21% excise tax is still in place, but what changed is the definition of covered employee. So under the old law, a covered employee is any employee who is one of the 5 highest compensated employees with compensation over $1 million. Starting for tax years after December 31st, 2025, a covered employee will be any employee that receives compensation in excess of $1 million during any tax year after 2016. So what this means is that nonprofits will now face a 21% excise tax on any salary exceeding $1 million for any employee. So no longer limited to just those 5 highest employees. Next, there was a change to the endowment tax on private colleges and universities. Currently, there is a flat 1.4% excise tax on the net investment income of private colleges and universities with at least 500 tuition-paying students and who have at least a $500,000 student adjusted endowment. This flat 1.4% excise tax is being replaced with a graduated system, you can see ranging from 1.4% all the way up to 8% for universities and colleges with the very large student adjusted endowments. The new law also increases the required number of students to 3,000 from 500, and private colleges and universities that this applies to will now need to report the number of tuition-paying students used to calculate the student adjusted endowment and the total number of students attending the institution on their Form 990. This is effective for tax years after December 31st, 2025. This provision is interesting. So this is a new tax credit for contributions to scholarship granting organizations. So now a U.S. citizen who makes a qualified contribution to one of these organizations can claim a credit on their individual tax return of up to $1,700. So you can see on the slide the definition, the qualifications to be a scholarship granting organization. And I think the key one that might surprise everybody is the last one, that you must be identified as eligible by the state, and the state must opt into this regime. My understanding is that Texas will opt in. So if you want to be classified as a scholarship granting organization, you will need to apply and be certified by the state of Texas, who will then send a list of eligible organizations to the IRS. So the IRS knows who actually qualifies as an SGO. Individuals who want to take advantage of this credit are not allowed to take the credit and a charitable contribution deduction for the same donation. Credits can be carried forward up to 5 years, and any scholarships received from SGOs will be tax-free to recipients. This will be effective for tax years beginning after December 31st, 2026. So I think what will be interesting is we'll see how this will impact non-SGO education-related nonprofits. Will those organizations start to see a lot more funding competition as donor dollars may start to shift more towards these SGOs so individuals can take advantage of this credit on their tax returns? All right, one bright spot in the OB3 for exempt organizations is changes to the new markets tax credit. If you're not familiar with this program allows investors to receive a tax credit against their federal income taxes for investments that they make in community development entities. Then those entities allocate funds to qualifying projects for eligible nonprofits, which are usually nonprofits that are operating in economically distressed areas. And these nonprofits can benefit from these investments in various ways, including expanding services in low-income communities, or what we see most often is financing for real estate projects or facility expansions or infrastructure improvements. This credit was previously scheduled to end on December 31st, 2025, but was made permanent by the OB3. The annual allocation limit of $5 billion remained the same, but new under the OB3 is this new 5-year limit on the allocation carryover, meaning if Congress allocates $5 billion to this program, then that $5 billion needs to be utilized within the next 5 years. Otherwise, it will expire unutilized. So the purpose of that is really to try to facilitate quicker deployment of capital in these economically distressed areas, and also to encourage nonprofits to utilize this credit. So if you are a nonprofit operating in economically distressed areas, I would definitely encourage you to look into this as a potential funding source. All right, let's switch gears now and talk about the ways that the OB3 impacts exempt organizations as employers. So the first is definitely a welcome change, and that's the increase in the information reporting threshold for business payments. I think everybody is familiar with the current $600 threshold, which will now be increasing to $2,000 and will be adjusted for inflation starting after 2026. It's important to note that this is only for payments made after December 31st, 2025. So this coming January, when you're doing your 1099s, make sure you're still using that $600 threshold for 2025 payments. But then hopefully next January 2027, you'll be filing far fewer 1099s using this new higher $2,000 threshold. All right, now let's talk a little bit about no tax on tips and no tax on overtime. Obviously, these were widely publicized in the media, campaign promises by President Trump. These are income tax deductions. So in the case of tips, an income tax deduction for tips received in tax years 2025 through 2028. What's important is that this only applies to cash tips in an occupation that customarily and regularly received tips on or before December 31st, 2024. So unfortunately, we're not all now able to convert our salary into tip income to be able to take advantage of this new deduction. The IRS has been directed to issue a list of qualifying occupations on or before October 2nd of 2025. So what probably will be more widely applicable, oh, real quick, there's an attendance poll, so make sure you check that if you want to get your CPE. So what will be more widely applicable is this no tax on overtime. Again, this is an income tax deduction for qualified overtime pay received in tax years 2025 through 2028. This is limited to $12,500 per tax year or $25,000 for married filing joint taxpayers. There are phase outs to this when adjusted gross income reaches certain thresholds. It's important to note that this applies only to federal income tax. So this overtime compensation is still taxable for Medicare and Social Security purposes. Also important is the definition of qualified overtime compensation. You can see the technical definition on the slide, but what this means is, for example, if you have an employee who's compensated at a regular rate of $10 an hour, for example, you pay time and a half for overtime, so the overtime rate is $15 an hour. This qualified overtime compensation amount is only that $5 excess above their regular rate. So it's not the full $15, it's only that $5 excess. This amount must be separately reported on the Form W-2, and many of you may be thinking, wait a second, we're almost all the way through 2025, and we haven't been tracking this information. We don't know this amount to be reported. There is a transition rule for 2025 where employers can approximate the amount that should be designated as qualified overtime pay by any reasonable method specified by the Treasury Secretary. We do not yet have that guidance from the IRS on how this will need to be reported on 2025 Forms W-2. The IRS has announced that there will be no changes to the 2025 forms or withholding tables. So you should continue to withhold using the withholding tables that you've been using for all of 2025. And then we'll just have to see what the IRS wants us to do as far as reporting this on the 2025 W-2. The IRS has issued draft 2026 Forms W-2 that reflect new Box 12 codes for employer contributions to Trump accounts, total amounts of qualified tips, and total amounts of qualified overtime pay. Those are still in draft form, so still subject to change. All right, I want to briefly mention Trump accounts from an employer perspective. So if you're not familiar, the Trump accounts are the new tax advantage saving accounts for children that are meant to function similar to individual retirement accounts. Contributions to these accounts are limited to $5,000 per calendar year, and contributions by employers to employees' dependents are excluded from the employee's gross income up to $2,500 per year. What's also interesting about Trump accounts is that there is no contribution limit for contributions from tax-exempt entities. However, general funding contributions from charities are only unlimited if they benefit a defined group. So, for example, all children born in a specific year or all children born in a geographic region. This is effective for tax years beginning after December 31st, 2025. The OB3 also made lots of other changes to fringe benefits and payroll credits. Some were made permanent, some were increased, some are listed on the slide. This is by no means meant to be an all-inclusive list, but a lot for your HR and payroll departments to be aware of. Okay, let's change gears a little bit now and talk about how changes to other types of taxpayers might impact exempt organizations. So there were lots of charitable related changes to individual taxpayers. The higher standard deduction put in place under the Tax Cuts and Jobs Act was made permanent. There's a new charitable deduction for non-itemizing taxpayers, $1,000 for single taxpayers, $2,000 for married filing joint. This is similar to the $300 above the line deduction that we saw under the CARES Act, but now it's made permanent and expanded. The 60% AGI limit for cash contributions was made permanent. New under the OB3 is this new floor for individual charitable deductions, meaning that a deduction will only be allowed if it exceeds 0.5% of the taxpayer's adjusted gross income. Also new under the OB3 is this overall cap on the value of itemized deductions. So meaning taxpayers in the top tax brackets are now only able to claim the value of itemized deductions up to 35 cents on the dollar. So even taxpayers in that 37% bracket will only get a 35% benefit on their charitable contributions. These are all effective for tax years beginning after December 31st, 2025. So what does this potentially mean for your organization? Well, fewer taxpayers are expected to itemize. We saw that after the implementation of the Tax Cuts and Jobs Act. But hopefully this new universal deduction will help encourage participation from those non-itemizing donors. This could be particularly useful in messaging to your broad donor bases for things like annual campaigns, etc. The 60% AGI limit really reinforces the tax incentive for larger cash gifts, but will we see this be undercut by the overall cap on the value of itemized deductions? A lot of people see that as a backdoor cap on charitable deductions for wealthier donors. And will this new floor on individual charitable deductions discourage some of your modest but regular donors? Taxpayers who itemize will not receive any charitable deduction until their gift exceeds 0.5% of their AGI. And remember what we talked about at the very beginning of the presentation. This is estimated to cost individual taxpayers $63 billion over the next 10 years. So as we saw after the Tax Cuts and Jobs Act, organizations, it will be very important to continue to focus on charitable giving around mission alignment rather than focusing solely on tax incentives. It also might be useful to discuss some of these changes with your donors in planned giving conversations through the end of this year. It might make sense for a lot of donors to make some larger contributions in 2025 instead of waiting until 2026 when these all take effect and they may get lower benefit from those contributions. We saw similar changes for corporate taxpayers. There is now a new floor for corporate charitable deductions where corporations can only deduct gifts above 1% of their taxable income. This really creates a disincentive for lower level corporate giving, especially among those mid-sized businesses. For context, according to the chief executives for corporate purpose, the median corporate giving rate was 0.83% in 2023, so well below that new 1% floor. This provision is estimated to cost corporate taxpayers $16 billion over the next 10 years. The 10% taxable ceiling remains as it has been in place for a while, but now only contributions exceeding the 10% ceiling can be carried forward by corporate taxpayers. So due to these changes, we might start to see an increase in bunching of charitable contributions by corporate taxpayers. They might start making larger contributions in 1 year and then lower or no contributions for a couple of years so that they can really get their contributions over these thresholds so that they can get a tax benefit. These are also effective for tax years beginning after December 31st, 2025. So a key change for planned giving professionals is the increase to the estate and gift tax exemption. This was increased to $15 million for estates and gifts made after 2025. This will also be adjusted annually for inflation. This was made permanent under the OBBBA, but I think we all know by now that permanent is a relative term when it comes to the tax code. So it is permanent in the sense that it is not currently set to expire. However, obviously, Congress could change this at any point in any future legislation. So lastly, just a comment on IRS guidance. Normally, when any new tax law comes out, we read it, and the first thing we think is, okay, what does that mean, and how are we supposed to implement that? So this new OB3 is no exception to that. There are a lot of questions about how this is meant to be implemented, and so we'll just have to wait for IRS guidance. Terry Lemons, the former IRS Communications and Liaison Chief, speaking at a recent AICPA town hall, said this is a massive bill. People should not be expecting an early announcement on when the IRS is going to open up for filing season, and a lot of patience is going to be involved. We've all obviously seen on the news the challenges that the IRS is facing. They're short-staffed, lots of changes at the most senior leadership levels. So we'll just have to be patient as we wait for the IRS to give us some guidance on how we're supposed to implement this bill. Okay, a couple last comments on some things moving away from the OB3. I just wanted to mention this in case you've seen anything in the media about the Johnson Amendment. If you're not aware, the Johnson Amendment is the addition to Section 501c3 that prohibits exempt organizations from endorsing political candidates or engaging in political campaign activity. So there's a recent court case involving two Texas churches arguing that the Johnson Amendment prohibits their right to free speech and free exercise of religion. In a court filing, the IRS said that communications from a house of worship to its congregation in connection with religious services through its usual channels of communication on matters of faith do not run afoul of the Johnson Amendment as properly interpreted. I just wanted to point out that this is a very narrow exception to the Johnson Amendment by the IRS. So political campaign activity is still generally prohibited for most Section 501c3 organizations. So if you have heard that the Johnson Amendment is repealed or that the IRS has changed its stance on the Johnson Amendment, that is not correct. So please don't go out and start engaging in a lot of political campaign activity. And lastly, I just wanted to mention, due to the recent flooding in Central Texas, the IRS has issued disaster relief for individuals and businesses in certain counties in Central Texas. I listed the counties on the slide. This was last updated on August 7th, but the IRS can and does sometimes add additional counties to these. So always check the IRS website for the most up-to-date list. But what this filing relief means is that certain deadlines that fell between July and February 2nd have been postponed to February 2nd, 2026. And this does include calendar year Form 990 for exempt organizations whose extensions run out on November 17th. It also includes certain payroll and excise tax returns and individual estimated income payments normally due in September and January. If you're wanting to take advantage of this relief, there's nothing that you have to do. It is automatic, and the IRS will base it off of the zip code that is on your tax returns that you file. So that was fast and furious, but now I will turn it over to Diana to start our FASB refresher.
Thank you, Shannon. This next session is designed to provide a refresher on key FASB standards that are critical to your financial reporting. We'll also be touching on some best practices as well as common challenges we've seen in practice. And there is a polling question that just came out. Please make sure to submit that. Our first topic on the next slide is conditional versus unconditional contributions. And I pulled this flow chart from the ICPA Audit and Accounting Guide. It walks you through determining if you have an exchange transaction or a contribution. If you have a contribution, it further walks you through the determination of the type of contribution you have. Essentially, a contribution is a transaction that is non-reciprocal. That means that each party involved in the transaction does not receive commensurate value. Let's go to the next slide and assume that you have a contribution and determine if you have a conditional contribution. And I'll preface this by saying that donor intent is important and sometimes not always clearly conveyed in a grant agreement. So in order to have a donor imposed conditional contribution, two things must be present. They're stated here on the slide. The first thing is that the agreement must include barriers that must be overcome before a recipient is entitled to the assets transferred or promised. And two, a right of return to the contributor or a right of release of the promise from its obligation to transfer assets. If either one of those two is not present, you do not have a conditional contribution. One thing that is sometimes missed is that the right of return or release must be linked to not achieving the barrier. And we'll talk through some examples of that. There's some reference to the guidance where you can see that described. Why do you care whether or not you have a conditional contribution or if it's unconditional? You care because it determines when you're recognizing revenue. If you have a conditional contribution, you recognize the revenue once the conditions are satisfied. People who like their revenues to match their expenses often prefer this recognition pattern. So if you are involved in working with the grantor to draft what that grant agreement is going to look like, you might want to go in this direction where it is more set up as a conditional contribution. Unconditional contributions, the revenue is recognized once that promise is made. So let's go to the next slide and take a deeper dive into determining what a barrier is and what it is not. That is the more challenging part of determining whether or not you have a conditional contribution. And here are a list of some indicators from the guidance that reflects if you may have a barrier. The first bullet point here. So your grant agreement includes a measurable performance related barrier. Some examples of measurable related barriers include a requirement that the nonprofit must achieve a specified level of service, an identified number of units of output, or a specific outcome. So let's break these down a bit. An example of a specified level of service is that if you're get a grant agreement and you must provide free health screenings to at least 1,000 individuals within the year. An example of an identified number of units of output could be that you're required to distribute 5,000 books to children attending Title I schools within the school year. And then an example of a specific outcome is within the agreement, it's telling you that you need to work towards increasing the passing rate of students taking the STAR test in AISD by 10% within 4 years. Other measurable barriers could also be a matching requirement. An example of that is you receive a grant agreement or a contribution that states that once you raise $1 million for the capital campaign, the donor will then contribute the next $1 million. Those are all indications of a barrier. On the second bullet, it speaks to an agreement limiting the nonprofit's discretion over a specific activity. So examples of this could be incurring qualifying expenses, such as a cost reimbursement grant, or a requirement to hire for a specific role within the organization to carry out a program. And then the third bullet states that the stipulations in the contract does not relate to the purpose of the agreement. So, for example, if the agreement, which most grant agreements have some sort of administrative report that must be filed at the end of the performance period, or that is not indicative of a barrier. It does not relate to the purpose of the agreement. So let's pull the thread on this third bullet point a bit more on the next slide. Items unrelated to the purpose of the agreement are not barriers. So let's talk about what is not a barrier. The first example here is what I just shared with that administrative agreement. It's a report that's required. It's a report indicating how the grant funds have been spent. That is not a barrier. Some grants require that you perform an annual audit. That is also not considered a barrier. This last bullet point this is where it can get a bit challenging or gray, and that's when the grantor is indicating that they have certain targets, best efforts, guidelines, or goals that they would like for you to accomplish. But they're not going to hold you to hitting those specific targets in order to receive the funding from them. If they're not going to hold you accountable to those things and it's just more of an encouragement to work towards these things, that is also not a barrier. Sometimes when looking at these grant agreements, it's not very clear whether it is a target or a guideline. And so it's really important at that point to make sure you're having conversations with those who are involved in working on the grant with the actual grantor. So that might be folks in your development office or executive director, et cetera. So let's go to the next slide. And let's say it's not and one thing I will say is if you are in a situation where it is a more gray area and you're not sure if it's conditional or unconditional, the guidance does direct you to just go ahead and be conservative and take a conditional approach because the revenue would be recognized once those conditions are satisfied. So if it's a contribution and it's not conditional, then it is considered unconditional, and revenue does get recognized immediately when you have unconditional contributions. So you could have a situation, for example, where you get a multi-year gift that gets recognized this year, but the spending on it's going to be over the next several years. This can really impact your bottom line. If you think about receiving a multi-year gift for $5 million, it's to be expended over the next several years, and you're recognizing that 5 million now, but the expenses are occurring in future years. So it requires a bit more conversation internally as well as with your stakeholders, and helping to understand and frame that story. When you do have an unconditional gift, you need to make a determination of whether or not you have whether it's restricted or unrestricted. Restrictions can be permanent or temporary, and they can be restricted. The restrictions, if it's temporary, can be restricted for time and or purpose. A time restriction could be that multi-year gift that I described, or grants that are intended to be spent in the future. Purpose restrictions are restrictions that are much more narrower in scope than the mission of the organization. And then when you're talking about unrestricted gifts, those are typically general donations, such as for an annual fund or for operations. Now let's walk through a couple of examples together. Here's a snip from a grant agreement that we have. On behalf of the foundation, I'm pleased to report that the Board of Trustees has approved a grant of $500,000 payable over 3 years. Payment terms are outlined. This grant should be directed to the capital campaign, and the first payment of $200,000 will not be made until notice of groundbreaking. Later in the agreement, it states that the foundation reserves the right to suspend or terminate its commitment and call for a return of grant funds should any of the following occur, which includes funds are not being used for their specific purpose. Do you have a conditional or unconditional grant here? On the next slide, you'll see you do have a barrier for breaking ground, and that is a specified outcome. Previous slide, please. Thank you. And there is a right of release associated with that barrier. So you do have a conditional grant. Therefore, you would recognize the $500,000 in revenue after the groundbreaking. You classify it all as temp restricted until the building is placed in service. And when we go further in this webinar, we'll speak to the timing of the release. On the next slide, we'll get to the second example that we'll walk through briefly. And this one comes straight out of guidance. NFPH is a recreational organization that provides various sports programs to children that live in the community. H receives an upfront grant in the amount of $40,000 from a foundation to be used towards its tennis program. Consistent with H's grant proposal, the agreement includes specific guidelines for which H could use the assets. For example, you could hire 10 tennis instructors or provide a summer camp for 9 weeks, but it does not specify that H's entitlement to the $40,000 is dependent upon H meeting any of the specific indicated guidelines in the agreement. The grant does contain a right of return for funds not spent on the tennis program. So do you have conditional or unconditional contribution? In this case, it is not conditional because the agreement does not have a barrier to overcome. The agreement had some guidance. Those guidelines, the outcomes were not required to be met in order to receive the funds. And so it is unconditional, and it's temporarily restricted with funds required to be spent on the tennis program. All right, now we're going to switch gears and talk about a new topic that we are seeing more of given the tax advantage to individuals when they do have donor advised funds or DAF. And we're going to read, donor advised fund or DAF is a separately identified fund or account that is maintained and operated by a 501c3 organization, aka a sponsoring organization. So once that individual makes the contribution to the DAF, the sponsoring org has the legal control over it, not the individual donor. The donor does retain advisory privileges with respect to the distribution of funds, but the sponsoring org holds the variance power. And variance power, who holds the variance power? That's the person or the entity that holds the control. So on the next slide, let's talk about revenue recognition and how it relates to DAFs. So if Susie emails you and lets you know that she's going to direct her DAF to contribute $10,000 to your nonprofit, do you recognize that revenue? No, you don't. You have to wait until either the DAF, you either receive cash directly from the DAF, or when the DAF sends a letter to you communicating that the funds are going to be released. Again, the DAF is the one that has the control over those funds, and so you have to wait for their notification. On the next slide, we'll talk about some common mistakes. The first one is what I just described with you, and that's prematurely recognizing revenue. The second is an unallowed, just to remind you that an unallowed activity is using your DAF to sponsor a nonprofit event and then still receiving benefits. So if a donor uses their DAF to sponsor a nonprofit event, they should not attend the event, receive a table, or any other perks. IRS guidance is that DAF cannot be used to provide a more than incidental benefit to the donor. You also can't bifurcate the gift. So for example, a donor can't use the DAF for a portion of the sponsorship and then cut a personal check for the non-deductible portion. IRS guidance can be referenced here at IRS Notice 2017-73. Double dipping is also not permitted. So donors can't receive tax deduction twice from the nonprofit and from the DAF for essentially the same dollars. And then lastly, I'll just say that you as nonprofits should continue to issue the acknowledgement letter to the DAF sponsoring organization, acknowledging receipt of the grant, but should not include tax deductible language since the donor should have already received a tax deduction when they originally contributed to the DAF. All right, moving on to tracking temporary restrictions and releases. And I will say that if DAF communicates restrictions to you, whether temporary or permanently, you will need to follow those rules around that as well. But tracking temporary restrictions and releases is crucial to ensure compliance and donor intent, as well as proper financial reporting. You don't want to spend your restricted dollars for operations or for some other purpose that the donor did not intend. Nonprofits are allowed to adopt a policy of simultaneous release for unconditional and or conditional gifts. And most of my clients have adopted the simultaneous release option. So it allows nonprofits to recognize certain restricted contributions as unrestricted revenue in the same period the restriction is met, simplifying the financial reporting. So on the next slide, let me explain. Oh, one more polling question for you. Look at the bottom of the chart here. This is an example of what the numbers would look like on a statement of activities, and an example whether you elected the simultaneous release option or did not. And when we think back on the example that I walked you through where you had a temporary restricted gift for the tennis program, and we'll say it was for $50,000. If you elected the simultaneous release option and you satisfied that restriction in the same year that you received the grant, you'd basically just reflect the revenue as net assets without donor restrictions on your statement of activities. Now, if you did not make the policy election, then your statement of activities would reflect the contributions in net assets with donor restrictions for 50 grand, and then you'd release that amount in that year as well. You can see the amounts leaving with donor restrictions, going to without. You get to the same answer at the end of the day. Your total revenue is still $50,000 in both cases, and your total revenue without donor restrictions is $50,000 as well. So the answer is the same at the end of the day. It's just a matter of how you want that presented. And I would say if you, once you make this election, you stick with it. You make sure to continue and be consistent with it. On the next slide. So ASU number 2016-14 came out and provided some guidance around just reminding, which changed when there are releases related to those long-term gifts. So you release net assets resulting from the gifts of PP&E or capital gifts restricted for construction to net assets without donor restrictions when the associated long-lived assets are placed in service. And this is why I commented when we went through the capital campaign example with the groundbreaking that you would not release those temporary restrictions until the asset is placed in service. Here we have some tracking tips for temporary restrictions and releases. And again, this is really important to do with throughout the year rather than just making it an exercise for purposes of the audit. You don't want to misuse donor funds, which could impact donor trust in your organization, as well as your reputation. And it's important for proper financial reporting, as well as effective management of resources as you're budgeting and managing your cash flows as well. So most of my clients tend to use spreadsheets to track these net assets with restrictions and their releases. And sometimes they pair that with structuring their GL in a way to track the restrictions and releases as well. As you are tracking the restrictions, please just make sure you're maintaining a clear audit trail by documenting the transactions, who the gift was from, any of specific terms. Uh, that way, it's easy for you to follow later, as well as it'll help during the purposes of the audit. It'll also help for anyone who might follow after you. And then lastly, I'll just say, have discussions with management, your finance committee, as well as your board about what the composition of these gifts are that are restricted. The frequency of this conversation will definitely vary by nonprofit, depending on the organization size, your complexity, as well as your financial health and liquidity. So at this time, I'm going to go ahead and pass the baton to Pooja.
Thanks, Diana. So we have about 15 minutes left. I have about 10 minutes of content. So if you have any questions about anything you've heard today, please use the chat function. If we can't get to your question during this session, we'll be sure to email you. So just wanted to let everyone know that. Okay, so the next couple topics I think might provide some challenges to nonprofit organizations, but also they're kind of unique to them as well. So the first one's in-kind contributions. So this slide provides some examples of the donated goods and services or use of facilities that you may see. I think the main reason this is a challenge for nonprofit organizations is because it is non-cash, right? So it's not hitting your bank statement. There may not be a lot of documentation. So it does require a lot of communication with the receiving department or your development teams to finance to let them know that something's been donated. And in some cases, it's donated and utilized right away. So you may miss reporting on it. But it is required for your financial statements to provide a full picture of what it takes to run the nonprofit organization. And just from an audit perspective, we tend to base our scopes on the total contributions and our materialities. And so when you miss these or don't book them initially in your trial balances, you may not be taking credit for some of how large your organization really is. Looking at the next slide, it's a little bit more information about the actual definition of what FASB defines a donated good or service. The main thing to remember here for donated goods is that you want to make sure that you are going to be using it for your nonprofit and it benefits them. And then for services, you want to look for specialized skills. So it does exclude volunteer activities. Anyone who's helping with administrative tasks don't need to be tracked as an in-kind contribution. And so once you've established that you do indeed have a donated good or service, it is the responsibility of management to provide a fair market value to that in-kind contribution. And this is where the challenge comes in. There's a lot of subjectivity to it. The easiest one, I think, is and considered a level one or the highest level without much judgment is the market-based valuation technique mentioned here. So using observable market data, what is the retail price? If you don't have that available with the donated good or service provided, you may consider using a cost-based approach. What does it cost to replace or reproduce the item? In some cases, income-based is the most practical. Say you're given a use of a facility, and typically the donor would charge $10,000. They're giving it to you for free. Then that is your fair market value. And then there are other approaches that you may consider on the next slide. Is like an appraisal. So like there are some things that where if you're buying like buildings or land, you may consider an appraisal, or it might just be like rare collectible. In some cases, you may be gifted an intellectual property that might require a specialized valuation firm. And then I don't see weighted average as much, but it is a technique that you can use if you're getting a large bulk of similar items. You may just value a subset of them and apply it to a larger population. And then every once in a while, a donor will provide a valuation. I just want to caveat that the nonprofit organization receiving the donated good or service, it's their responsibility to make sure that is a reasonable fair value principle that they're using to provide you that value. So it does come to the accepting party to make that. And then looking at the considerations in general, I think I mentioned a couple of these. Just the condition of the good or service provided, like are you actually using it? Is a donor imposing any restrictions on the use of that donated good or service? Think about what documentation you need to keep to determine the fair value. And then just remember geographic market matters. Something might be of more value in the state or location you're in versus the donor giving it to you. The next topic is the functional allocation of expenses. So it is a requirement for nonprofit organizations to allocate their expenses in a functional manner. And the goal is really to provide transparency of how the nonprofit allocates its resources to fulfill its mission versus administrative or fundraising activities. So there's typically we're seeing it in a full statement of functional expenses. The basic principle here is that you're going to have all of the expenses that you've had in the year, and you're going to need to allocate them to program services or support services. You may have various program services and then various support, which would be G&A, you can have fundraising. It really just the main thing, it helps the donors, grantors, and stakeholders assess the efficiency and effectiveness of the organization, really looking to see that most of the expenses are being spent on program services, for example. And this is sometimes really easy and really straightforward, but it can get complicated when you have a lot of shared expenses that you need to allocate between different functions. And so on the next slide, I'll go over kind of some of the ways that you can do it. So some of the easier ones maybe just be square footage. You have a rental facility, you're renting and you're paying rent expense, and one department sits here and one department sits there, and you can do it on a square footage basis or a head count basis. If you're dealing with someone who works sometimes in programs and sometimes in support, you may do an allocation based on time or percentage of their time versus on program versus admin. And then there may be some things that are just easily split between usage. You have IT subscriptions for accounting software that might just be allocated to accounting, or you have a fundraising event and that's all fundraising. And so you're using a lot of different methodologies in this one statement, depending on the nature of the expense. So some considerations to think about as you're doing this allocation. This can be a very time-intensive project. There's a lot of subjectivity in how you allocate which type of expense. And then regulatory and compliance, partly us, we're looking for consistency in the allocation methods year over year. That doesn't mean that you can't decide to change or revamp if the organization is looking at expenses differently or has realigned their departments. You would just, in a comparative report, have to go back to prior year and make it consistent for the prior year. And then stakeholder scrutiny. I think the best way to kind of understand what expenses are being spent where is really good documentation. So maintaining clear records of how your allocation methods and the assumptions, and evaluating it for reasonableness every so often, just to make sure. I know a lot of your organizations are changing and growing, and the way you used to do it may not make sense, and then you keep adding different principles and estimates on top of it, and it may just become really complicated. So again, complex area, a lot of judgment and like scrutiny on it. It just really provides the users with a lot of information. And so taking additional time to document, understand your allocation methods will really help answer some of those stakeholder questions. So that's all I have. We have about 7 minutes. I need a minute or two just to wrap it up. But any questions that we can help answer today?
There was one in the chat. I answered it in the chat, but I thought it was a good question, so I'll go ahead and address it so that everybody can hear the answer. The question was whether the 0.5% AGI deduction floor is on each individual charitable donation or whether it's cumulative. So it is cumulative. You're looking at everything in total. So for example, if you have AGI for a taxpayer that's $100,000, and their total charitable contributions all added up, all the contributions they made for the year are 5,000. Only 4,500 will be deductible. So that first 0.5%, $500 is not deductible, and they lose that benefit.
We have one more polling question, and if you missed one, we just need 3 of the 4 to give you guys credit. Any other questions before we wrap up today? We got our 50 minutes, so we get CPE. If there aren't any more questions, we know that was a lot of information, and we appreciate you spending time with us today. We'll be sending out a follow-up email that includes the full presentation, so you can refer back to it as needed. And if there's any questions that we didn't answer, feel free to ping us with our QR codes or include it in the in the chat here, and we'll be sure to email you back. I wanted to let you all know that we do have 2 more webinars that are coming up in the fall that are scheduled. One is related to talent acquisition strategy, and the other one is for strengthening compliance. So it's a single audit update and common pitfalls for nonprofits as it relates to government funding. And so look out for those if you can join and need CP credit for those. We'll also be processing the CP credit, and you should receive a certificate by end of day tomorrow. But we thank you for your time today.